Hello, and welcome to myfinanceteacher.org. In response to one of the viewers' comments, we're now looking at a selection of oil producers that you might be interested in based on the discounts that you are getting now in the oil industry, as well as attractive dividend yields. Before we continue, let me remind you guys to subscribe to the channel if you haven't, and click that bell notification. Thanks a lot. First of all, let's have a quick look at crude oil price itself. I think we're near the completion of an intermediate cycle, although it's not very clear to me how long is that cycle. One way to count the cycle is consider this whole period from summer last year until possibly 9th of March as one cycle, in which case it's a relatively extended one lasting for 278 days. And another way to look at it is to view it as two cycles here between summer and October last year, which would give us a short cycle of only 120 days, around 4 months instead of 6 months, which is a possibility as well. And we're now almost completing another cycle that has been going on since early October. That would give us 5.5 months, just under the usual duration for these cycles. Whichever way we look at it, I think nowadays, in general, over these weeks, while crude oil is relatively cheap, we're going to see a rare buying opportunity over the long term. In the short term, we might still see the economy doing poorly with a lot of flight and event cancellations. But I think over the long term, you will look at this period as a very nice buying opportunity. The last time crude oil was close to $26 was all the way back in 2016. And if you were to invest into crude oil around that time and hold for a couple of years, you'd have around 150% gains over a couple of years. I think we're having a similarly attractive opportunity here, provided that you invest into relatively stable companies that would not be destroyed by this substantial decline in crude oil price. So in this video, I want to have a look at a few, I think, top 20 of the largest oil producers in the world, and analyze how likely are they to cut their dividends. First of all, as I mentioned, you don't want to invest into small, especially shale oil producers, as those might go out of business if crude oil prices stay low for a while. So the first step in selecting your nice dividend-paying companies is to stick to established producers. And we are going to start with BP. Looking at dividend history, over the more recent history since early 2015, we see that BP did not cut their dividends. Not even in early 2016 or soon after that, when crude oil price dropped all the way down to $26. So that is a positive sign on BP. Looking at some other dividend-related measurements, currently BP is paying 94% of its earnings as dividends. A higher payout ratio indicates a risk that the dividends might be cut, especially if this ratio exceeds 100. Another indicator that I'm interested in is the amount of debt that the company has. If the debt burden is too heavy, then the company might have to cut their dividends. We see that the amount of net long-term debt that BP has is around 12% of total assets, which in my opinion is not a very substantial debt burden. And looking at the history of payout ratio, in 2016-2017, when the earnings dropped with the low crude oil price, the payout ratio had even reached 400%. And even then, BP didn't cut its dividends. This, I think, is a positive sign, given that currently the payout ratio is just under 100. Meaning that even if BP were to cut their dividends sometime in future, that probably is not going to happen until this ratio exceeds 200% or higher. Next, looking at ConocoPhillips, we see that this company does have a history of decreasing the dividends by 2/3 in 2016. Again, that's the time when crude oil price reached very low price. So that is a negative sign from dividend history. Payout ratio is relatively attractive at 57%, and only 6% of total assets are burdened by net long-term debt. So although the payout ratio and the amount of debt are looking good, the history shows that when crude oil price drops significantly, ConocoPhillips has a tendency to cut their dividends as well. So I personally am not going to get into this company. Although this doesn't mean that ConocoPhillips is a bad choice. Looking at the payout ratio, we see that the dividends were cut when the payout ratio reached over 3,000%. So the current 57% actually looks relatively safe. Let's have a look at Chevron. Chevron didn't cut their dividends even when the crude oil price was low in 2016, so that is a positive sign for Chevron. Their payout ratio is 88%, which is even better than that for BP, and their net long-term debt to total assets is about 7.5%, which is also looking good. We see that even when the payout ratio reached 400%, Chevron didn't cut their dividends. So the current payout ratio of 88% is relatively attractive. Over these weeks, I will be gradually scaling into companies like BP and Chevron including. Next is Eni, the Italian company. We see that they do have a history of cutting dividends. So that's the first cautionary sign on Eni. The payout ratio is over 100%. I don't like to see that, to be honest. Although net long-term debt to total assets is just around 5%. So due to the history of cutting dividends and relatively high payout ratio, I personally would not be buying Eni. But you gotta make your own decision, of course. EOG Resources looking good. Dividend is growing substantially over the recent years. They didn't cut their dividends in 2016 when the price of oil was quite low. The payout ratio is only 35% and long-term debt is only under 6% of total assets. We see that payout ratio had historically even reached nearly 300%, so the current ratio of 35% is relatively safe. So EOG Resources is one of the companies I'm interested in. Next, looking at Enterprise Products. Again, a very good history of dividends, no cutting here. Current payout ratio of 82%, that is attractive to me. Although long-term debt is relatively heavy, 41% of total assets. From the chart here, we see that even when the payout ratio was nearly 130%, the dividends were not cut. So the current 82% does look attractive, although debts are relatively high. So I personally might allocate just a little bit into Enterprise Products. Norwegian Equinor, a little bit of a strange history here. They didn't cut the dividends in 2016 when crude oil price was depressed. There was a spike of dividends in 2018 which was cut back down. The payout ratio is over 95%. Long-term debt is only 8% of total assets, and when the payout ratio was over 300%, the dividends were still maintained in 2016-17, although there was a spike and a cut in 2018. So something to think about on Equinor. They didn't really actually decrease the dividends. There was a spike and the dividends returned to regular levels. So I'll think about this company when I have time. Petrobras, very irregular dividends. I don't like seeing that, although the payout ratio is very small, under 20%, whereas the long-term debt is nearly 22% of total assets. It's a little bit on the high side, so I personally will stay away from Petrobras. Royal Dutch Shell, very stable dividends in the recent history. The payout ratio is a little bit high, over 100%, but their long-term debt is only 8% of total assets. And in 2016, when the payout ratio nearly reached 250%, the dividends were still not reduced. So a current 109% of payout ratio might still be maintained. Something to think about when you're considering Shell. Schlumberger, also stable dividends over the recent history, although the payout ratio is also somewhat high, over 130%, and long-term debt are over 22% of total assets. Although the dividends were not cut when the payout ratio exceeded 200%, the current payout ratio is not that far from recent high. So still something to think about. If I do allocate some capital to Schlumberger, that would be relatively small amounts. ExxonMobil, again, stable dividends in recent history. However, the payout ratio is 147%, small ratio of long-term debt to total assets of only 6%. So although dividends were relatively stable, the payout ratio is currently somewhat high. So personally, I'm still considering whether to invest into ExxonMobil or not. And here we come back to BP again. So we are through the circle of these top 20 oil companies in the world. Let me know what you guys think. Do you believe that one of the best times to invest into the markets is when everything is depressed and sold at a discount? Consider this BP, for example, at the price of around $25. You get about $2.50 in dividends. That's about 10% in dividend yield. As crude oil price recovers, if the price of these companies recovers by, say, 50% over the next couple of years, that's a capital gains of 50% and 20% in dividends over 2 years. So 70% return in 2 years, I think is very possible, and in my opinion, that is an attractive level of return. So stay healthy, stay calm, remember to hit that like button, and good luck in your trades.